Trump receives a harsh reality check from bond vigilantes, a lot of optimism on the street for the Indian economy, and why I'm upgrading JP Morgan. This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode of the Stock Doctor podcast. We are on episode 129. First of all, first of all, very, very happy Memorial Day to all my US listeners. I hope you had a wonderful holiday, extended weekend with your families and friends, and hope you had a good time. And obviously, the UK as well had an extended weekend as well with Spring Bank holiday yesterday. It can only mean one thing, that obviously yesterday there were no market session. Markets were shut. There was no trading happening yesterday, both in the UK and the US. But anyway, hope all of you guys had a wonderful, lovely Memorial Day with your friends and families. Now, we start off, coming back to the markets. What started off as a very positive week last week, thanks to significant progress on the big, beautiful bill, quickly went south thanks to rising treasury yields and President Trump's resumption of trade wars. Just when we thought the trade war was a pause after the 90-day pause issued on China, the Chinese tariffs, we are back again. And as a result, what turned out to be a good positive start for US markets, by the time it rolled into Memorial Day, turned out very south as the week progressed. And once the dust had settled, sentiment had turned negative once again, all three indices ending the week deeply in the red. The Dow and the tech-heavy Nasdaq both slipped 2.5%, and the S&P 500 slipped 2.6%. Now, the pendulum of sentiment swung so fast, and the only evidence you need to see is that the volatility index, the VIX index, actually jumped 30% for the week. So that's a massive jump, and that goes to clearly show how much, how things are dramatically changing, giving more support to my thesis that volatility is the name of the game. Now, so without further ado, lots to go through. Let me welcome you to the Doctor's Weekly Snapshot and discuss the week gone by in the US markets. Let's get to the positive news first. I mean, I don't want to really say positive. I would say somewhat positive. Maybe, if you're the ultimate optimist, you find some positivity there. I know, however you want to put it. And that was President Trump's big, beautiful tax bill, one that looks at tax cuts and deregulation, finally passing the House and is now currently headed to the Senate. Now, the bill prolongs tax reductions originally enacted in 2017. Remember the famous Trump tax cuts of 2017. It fulfills a central Trump campaign pledge. By the time when he was running for president, he had basically said that he would be extending the 2017 tax cuts, and that's exactly what the bill that passed the House does. It also introduces tax exemptions for tips, overtime pay, and social security benefits, and raises the standard deduction. And these were all campaign pledges made by President Trump. So one must be one very happy man. The legislation allocates new funds for border security in the military. However, here's the catch: significant reductions are proposed for Medicaid, food aid, and higher education funding. We all know about the battle between President Trump and the Department of Education and how he wants to gut the organization, all of that. Again, this is not a political show. I'm just taking you through the bill highlights. The bill raises the federal debt ceiling by $4 trillion, not particularly great. More on this later. It phases out or eliminates tax credits for clean energy projects established by Democrats in 2022. Finally, the cap on the so-called SALT, which is the state and local tax deductions, has been increased from $10,000 to $40,000 and is a move aimed at winning over House members from high tax states, specifically New York. So the state and local tax deductions, the SALT has been also increased from $10,000 to $40,000. Now, here's why I say the entire thing is just somewhat positive. I've already given you some hints as to why things could go down, things could go wrong with this. But the positive news, if you want to really look at the positive outcome of this, or positive, if you want to look at the bill positively, let's say, is that the bill has passed the House, something that was absolutely considered impossible at the start of the week. It actually took direct intervention from President Trump and himself to ensure that the bill got passed, and I think it was basically by one or two votes, 215 to 214 with one abstention. I think that was the final tally. And it's actually one of the reasons why I consider this development to be partially positive, because at one point it looked like completely this is not happening, got to go back to the drawing board, and it was a make or break for President Trump. Well, that's no longer the case. from a House perspective. Now, there are challenges awaiting the bill at the Senate, with Republican senators expected to repaint some of the interior walls, as one senator put it, making changes to reflecting their priorities without really dismantling the core of the bill. So most likely all these tax cuts, extending the tax cuts, taxes on tips would probably be continuing, but there is always obviously some things like salt and some things like cuts to Medicaid and so on could be under scrutiny at the Senate. Now, with a narrow majority, Senate Republicans can afford to lose only 3 votes if all Democrats oppose the bill, and it would take something monumentally crazy for any of the Democrats to support the bill. And actually, dissent is already emerging among the senators. And that's why I said partially positive. Things could go already wrong. For instance, senators from states with significant renewable energy investments or high property taxes are wary of provisions that would harm local economies or remove popular incentives. Some senators also want deeper spending cuts, particularly to Medicaid, while others seek more generous or permanent tax relief. Moreover, one has to factor in that any amendments that the Senate makes will have to get back to the House and they will have to approve before it gets sent to President Trump's desk. When you take all these obstacles, then the target of finalizing the bill by July 4th, the Independence Day, looks highly unlikely. If at all, it looks impossible for now. And then there's the biggest obstacle of all, something that ensured that any positive surrounding the bill's passage evaporated in the blink of an eye. The Congressional Budget Office estimates the bill would add $2.7 trillion to federal deficits by 2034. That's about 9 years from now. Although some analysts actually suggest the impact could be as high as 3.8 trillion. And this, along with the Moody's downgrade, brought out the dreaded bond vigilantes, who ensured that the Treasury yields skyrocketed to dangerous levels. At the same, I did tell you it's not a political show, it's an investment show, and that's how I'm getting to it. At the same time, the auction for the 20-year Treasury bills was muted, which further drove the yields up. And therein lies the main central theme of this week's Doctor's Weekly Snapshot: the Treasury yields and the role that the dreaded bond vigilantes have played. Look, the 10-year US Treasury yield, on the face of it, the 10-year US Treasury yield has risen to about 4.5%, 4.55%, back to the level at the start of 2025. And below the 5%, it hit in late 2023. This rise is absolutely not a sign of panic or crisis, but investors would be foolhardy if to actually ignore this. It is significant. It reflects a fundamental change in market dynamics, not just temporary volatility. The danger is not that the current levels, but rather the reason behind the yield spike. It's not due to inflation, which is one of the main reasons. It's not due to the Fed policy. That's one of the reasons. Not even due to higher economic growth, which would have been absolutely perfect. As high economic growth, people sell bonds, move into higher aggressive equities. The more aggressive equities, that would have been perfect. No, the reason is the sheer volume of government bond issuance, a topic that has not been discussed for a while when it comes to rising Treasury yields. In other words, investors now demand a higher term premium. I'm sure you would have heard about it in your undergrad classes if you're learning finance or economics. But if not, it's basically the extra compensation for holding long-term bonds. That's higher term premium because of increased supply and fiscal uncertainty. So it's the increased supply, a factor that has never been into consideration for a while when it comes to rising Treasury yields, that's actually driving the Treasury yields upward. From 2016 to 2024, the term premium was negative, but it has now actually turned positive, returning to pre-financial crisis norms. It also doesn't help that the US fiscal deficit is fast becoming an outlier relative to other developed economies. The US federal deficit exceeded 6% of the GDP, no small number, by the way, guys, last year, and is actually projected to surpass 7% for the next decade, a level unprecedented in US history and much higher than other advanced economies. The US accounts for a disproportionate share of global deficits from 2023 to 2030. It will represent 2/3 of all advanced economy deficits, up from half before 2023. So you're going from 50% of the entire advanced economy deficits to now about 66.67% of the overall entire fiscal, advanced economy's entire fiscal deficit. At the same time, what it has done, what these rising fiscal deficits, what the Moody's downgrades, all of these have done is that actually the dollar's status as the world's reserve currency is now under threat. I mean, because the dollar status as the world's reserve currency historically allowed the US to borrow at lower rates. As yields have risen recently, the dollar has weakened, suggesting this exorbitant privilege that the United States enjoys is slowly getting eroded. And exorbitant privilege is actually, it's a phrase coined by one of my favorite journalists of Wall Street Journal, Greg Ip. Definitely, I would urge you to, read his columns on Wall Street Journal. I think it comes out once a week or twice a week. So it's really, really very, very useful information if you guys have Wall Street Journal subscriptions. Now, with the US debt reaching unsustainable levels, especially since the big, beautiful bill that the House passed calls for deficits at 7% of the GDP indefinitely, the lack of fiscal discipline at Washington is there for everyone to see. And investors, instead of shrugging it off, are actually taking considerable action today, which is why you see Treasury yields spiking. And yield spiking is not good for the housing market, which has been on a decline for a while, because why would you buy a house with mortgage rates at 7%? And certainly not great for the stock markets, hence the speed with which the positive sentiment swung to negative in the equity markets. We started off with positive on Monday. By the time Friday came in, it was definitely negative. Of course, I wish it was just the worries about fiscal deficit that rattled investors. Nope. President Trump, after ensuring there was a period of relative calm on the tariff front since the US-China trade war was paused, was back at it again. This time, the target, another favorite target of the president's, the European Union. On Friday, the president announced via social media that due to a lack of progress in trade talks, he would impose a 50% tariff on EU imports starting June 1st, 2025. The deadline, thankfully, was extended to July 9th by Sunday, after President Trump said that, after some following, it was extended to July 9th following a call between the president and the EC, the European Commission's president, Ursula von der Leyen. He cited the EU's value-added tax and regulatory barriers as unfair practices. The baseline tariffs on the European Union goods had previously been set at 10% after being reduced from the earlier 20%. Remember the whole reciprocal tariff and the pause on the reciprocal tariff, with some products like cars facing obviously higher rates, the 25% auto tariffs. You look at all these auto tariffs and now you wonder why, I've got to have multiple notebooks and multiple calculators to figure this all out. Imagine what the actual trade guys must be going through. At the same time as the European Union, President Trump also specifically targeted Apple, threatening a 25% tariff on iPhones and other smartphones not manufactured in the US. Because, hey, that's only fair. I'm not going to specifically target Apple, even though I am. But Samsung, you too get the 25% tariff. Not a political show, guys. He stated that unless Apple moves production to the US, it would face this penalty. The tariff would also apply to other companies such as Samsung, like I said, if their smartphones are made outside the US. President Trump reiterated his expectation to Apple CEO Tim Cook that iPhones for the US market be built domestically. Apple shares dropped 3% on the news, and this was on Friday, and the major stock indices fell between 0.6 and 1% again on Friday. Like I said, for the week, S&P 500 declined. All three indices ended in the red. Now, should these tariffs be implemented if negotiations fall, then the tariffs could significantly impact the cost of consumer electronics in the US and disrupt transatlantic trade all in one go. And basically, you all know that transatlantic trade is among the world's largest trading relationships. The EU has indicated readiness to defend its interests if necessary. Again, kind of a shot across the Atlantic. The odds of the tariffs being implemented are not insignificant, especially since President Trump stated that he's not looking for a deal with the EU, while European officials emphasized ongoing negotiations. So that's the news. Now, here's what I am thinking, and here's what I'm probably sure you guys are thinking as well. We have been here before, right? And it can't be surprising that the tariff-related news are coming out of nowhere. Told you volatility is the name of the game, but does it mean that investors should panic? Short answer is no, because when reciprocal tariffs were announced, initially there were comments that the tariffs would be permanent and there was absolutely no wiggle room whatsoever. 7 days later, they were paused for 90 days. I'm not saying that President Trump is bluffing. Absolutely not. I take that man very seriously. But investors should be taking it with a pinch of salt. Not a lot, but a pinch. Are the odds of tariffs being implemented zero? No. But are they 100%? Also no. Unlike reciprocal tariffs, the recent tariffs, the 50% tariffs on the EU announced on Friday, were announced on social media and were not part of an executive order. This makes them more bark than bite for now. Like I said, within 24 to 48 hours, the deadline was extended from 1st June to 9th July, which again lends support to the more bark than bite thesis or argument. At the end of the day, I do believe some form of deal would be reached between the European Union and the United States. They're too big of partners for them to simply just go to war on a trade front. At the same time, I do expect there to be some tariffs on EU imports. The EU can say all they want that we don't want, we're not like Britain, we don't want the baseline 10% tariff. That ain't happening. Like I said, the UK made a trade deal, the 10% baseline tariff stayed. So don't expect a path to 0% tariffs, no matter how much the European Union in social media, public media says they are insisting and they want it and they're not going to wilt over it. Yeah, well, at some point, it's not going to be the path towards 0% tariff. If you are realistically thinking that, yeah, you gotta go back to the drawing board and scratch that and throw it in the bin. Start thinking that there will be some case of tariffs. So the tariffs related to the EU, there will be some form of resolution as far as I'm concerned. The Apple case, however, is trickier. In my opinion, Apple is more likely to swallow the 25% tariffs rather than going back to the US to manufacture iPhones. Manufacturing iPhones in the US is simply not feasible. And according to some estimates, the price of an iPhone, should they be wholly manufactured in the US, designed in California, manufactured in wherever, New Jersey, whatever you want to put it, could top $3,500. So don't hold your breath on Apple building iPhones in the US. $3,500 iPhone, yeah, that's a bit too much. Even the 25% tariff, they can swallow it, and it'll definitely, your iPhone will not be $3,500. The question then becomes, how can Apple justify any tariff-related price increases without directly attributing it to tariffs? I mean, if they did that, then you expect a public rebuke and positively more punitive actions from President Trump. You don't believe me? Just ask Walmart. The upcoming WWDC Developer Conference, Apple's flagship event, should offer some insights into it, hopefully. I'm only saying it hopefully. I don't know. But investors better hope, again, like I said, hope that Apple has made enough progress on the Apple intelligence front that they can use that as an excuse to raise prices. Such a tricky situation for Tim Cook and Co. to be in, which explains why the stock is currently on an 8-day losing streak. So don't be surprised that Apple, a lot more volatility in the stock, at least in the build up towards the WWDC conference. Bottom line, the EU tariffs are not worth worrying over. The end goal would be some form of deal by the looks of it. Apple investors, on the other hand, will have to hope for a significant development at the WWDC. What investors should really watch out for, though, is the fiscal deficit. It's not the tariffs, it's not the Apple, it's the fiscal deficit, which as things stand is on track to spiral really out of control. As things stand, neither the Congress nor the Trump administration is showing absolutely any willingness to make the tough choices needed to control the deficit. At the same time, with the US economy running near full capacity, more government borrowing is seen as inflationary, potentially forcing the Federal Reserve to keep interest rates higher for longer. And as the US must pay more to attract buyers for the debt, this increases the interest cost, which in turn worsens the deficit. A vicious cycle is then formed, if it not formed already. The bond market's sharp reaction to the latest Treasury auction and deficit increasing legislation is a clear warning to Washington. Investors are losing patience with persistent fiscal indiscipline, demanding higher yields to lend to the US government. This dynamic threatens to push borrowing costs across the economy, slow growth, and undermine confidence in the dollar's global role. Without decisive action to rein in deficits, ladies and gentlemen, the US risks further financial instability and economic headwinds. And trust me, no one, absolutely no one, wants that. That, on that very cautious note, set to the next segment, The Doctor Goes Home, where I promise you the news is a lot more positive. And the reason why it's a lot more positive is we got some very positive economic data last week, with a lot of major banks upgrading their GDP forecast for the Indian economy for both the fourth quarter and for 2026. Unfortunately, all this positive news was overshadowed by rising yields in the US economy and the resumption of President Trump's trade wars. Let's start with the GDP forecast first. First, there was a report by Union Bank of India, according to which the Indian economy is expected to accelerate to a 7% growth rate in Q4 FY25, up from 6.2% in the previous quarter. The revised full-year GDP growth, however, was lowered to 6.3% from an earlier projection of 6.5%. Still very strong, still inputs India as the fastest growing economy in the world. The report notes a mixed trend in the high-frequency indicators, but the economic activity index suggests a slight upward bias. The activity index tracks private sector activity, excluding agricultural and governmental activities, and that is actually projected to rise to 6.8% in Q4 from 5.9% in Q3. This recovery in the private sector activity is attributed to several factors, including a possible revival of rural demand, continued government spending, and the economic impact of large-scale religious events such as the Mahakumbh, which is estimated to contribute to 2 to 3 lakh crore rupees in nominal growth alone. So that was the Union Bank of India report. Then you had the Morgan Stanley report, according to which for FY 2026, the GDP forecast is raised to 6.2% year on year from 6.1%. And for FY 2027, it is increased to 6.5% from 6.3%. The primary reason for this upward trajectory, upward forecast cited is the de-escalation, the potential de-escalation of US-China trade tensions, which is expected to improve the outlook for external demand, albeit marginally. The report emphasizes that domestic demand will remain the main engine of India's economic growth, especially given the ongoing global uncertainties. There's no surprises there. The recovery in consumption is expected to become more broad-based, according to Morgan Stanley, with urban demand improving and rural consumption already robust. The GDP growth upgrade by Morgan Stanley reflects cautious optimism for India's growth, driven by improved external demand conditions and ongoing strong domestic demand. Continued policy support and gradual recovery in private investment. More or less what I've been telling you guys about how much the tax cuts, RBI's role, governmental support, continued governmental policies, the budget 2025, the impact from that, all of that, it's pretty much, this is all, fancier words, but it's kind of something that this shouldn't come as a surprise. This shouldn't come surprising to you as if you are a long-term Indian investor, or for that matter, if you've been watching the show for long. Morgan Stanley, in a separate report, also offered an update on the trajectory of the Indian equity markets. It has set a new base case target for Sensex at 89,000 by June 2026, and that represents an 8% upside from previous projections. The target replaces the earlier December 2025 target of about 82,000, so it actually sees a 7,000 jump. The new target implies a trailing price to earnings multiple of 23.5 times, which suggests expensive valuation actually, which is above the 25-year average of 21 times. Thereby, it does suggest it's a base case, but it's clearly giving the Indian markets a re-rating. That's what's happening here pretty much. The 89,000 target is based on robust domestic growth, slow but non-recessionary growth in the US, benign oil prices, favorable India-US trade deal, 50 basis point reduction in short-term interest rates, and a positive liquidity environment. Morgan Stanley assigns a 50% probability to this scenario. Not bad, not particularly convincing, but not bad at all. Now, the brokerage expects Sensex earnings to compound at 16.8% annually through fiscal year 2028. Morgan Stanley's bull case actually is what will really drive your brains crazy. Bull case actually sees a Sensex target of 1 lakh within the next 12 months. Before you get excited though, this is the thing. When a brokerage gives you a bull case target, it's bull case. It's bull case, base case, bear case. So you got to take, it's one scenario, right? It's one particular scenario. Now, before you get too excited about the Sensex reaching 1 lakh within the 12 months, according to report, for the Sensex to possibly reach 1 lakh, following conditions will have to be met. And there's a lot. Here we go. Oil prices persistently below $65, GST rate cuts, progress on farm loss, earnings growth at 19% CAGR, and relief from global trade wars. The last part not happening anytime soon. Given that President Trump has absolutely no intention of ending the trade wars, and given that we have absolutely no idea how the bilateral trade agreement would look like between India and the US, and what the timeline of the bilateral trade agreement would be, I think this is a pretty overly optimistic target, and the probability of a bull case, Morgan Stanley's bull case, is definitely less than 50%. At least what I would be focusing on is that the base case scenario is improved. If I was an investor, I would look at their base case scenario rather than the bull case scenario, and it's jumped from 82,000 to 89,000, and realistic targets have been set to achieve that particular base case. And so I would be more looking towards that than the more optimistic. I wouldn't be making my buying decisions based on a 1 lakh target. I would be focusing it on 89,000, 89, the new base case of 89,000. Finally, there was a report from Barclays which forecast India's GDP growth at 7.2% for the fourth quarter of FY25, much higher than the 6.2 growth in Q3. It's one of the highest forecasts among all the brokerages and the banks and the government bodies and so on. The improved growth is attributed to surge in net indirect taxes, which grew by 30% year on year in the Jan to March quarter, and an uptick in the agricultural sector. Gross value added in agriculture is expected to rise to 5.8% in Q4 from 5.6% in Q3. Barclays notes that monetary easing began only in February. True. And the transmission of lower interest rates is still working its way through the real economy amidst abundant liquidity. The lower cost of capital is expected to eventually support industrial growth in the upcoming quarters. For FY25 as a whole, Barclays forecast GDP growth at 6.4%, which is which actually surprisingly you have a 7.2% for Q4 GDP, much higher than pretty much all brokerage. But the overall FY25 GDP forecast is at 6.4, which is actually below the estimate, the government's estimate of 6.5%, and the RBI's projected estimate of 6.6%. So there's some kind of mismatch there in terms of the projections. Speaking of rate cuts, transmission. Barclays talked about how the transmission is taking its own time. But speaking of rate cuts, we also got some very positive insights from RBI Governor Sanjay Malhotra, thanks to an interview he gave to Economic Times. Mr. Malhotra mentioned that Governor Malhotra mentioned that given that RBI's monetary policy has been changed to accommodative, future moves could be either status quo or rate cuts, which means effectively he's ruling out any rate hikes, depending on monetary policy committee's assessment. So there's no rate hikes. It could simply be whatever we are, or it could involve a rate cut because the stance has went from neutral to accommodative. Moreover, Governor Malhotra also highlighted that the RBI has infused about 9 lakh crores of durable liquidity into the banking system, which remains in surplus. The aim is to ensure adequate liquidity for effective transmission of the policy rate cuts. When you take all of these data points and insights together, the bottom line is that there is a lot for investors to be optimistic about when it comes to the Indian growth story. Having said that, caution is still warranted in the near term. The US credit downgrade and President Trump's tariff threat led to a jump in US Treasury yields, as I've mentioned before, and the situation in the US has the potential to have an indirect impact on the Indian markets. This is why you saw foreign institutional investors, FIIs, becoming net sellers for the week. More specifically, FIIs withdrew a net 11,591 crores from Indian markets during the week, and the selling occurred amid choppy market conditions, partly triggered by the Moody's downgrade of the US credit rating due to rising debt, heightened by President Trump's threat to impose 25% tariffs on Apple. All of that led to FII selling across in the Indian markets in the week gone by. The iPhone part is particularly worrying, especially since Apple has made plans to move more of its manufacturing to India to reduce reliance on China. While this is great news from an Indian economic standpoint and the Made in India initiative and all of that, there is also the possibility that India could again fall on President Trump's radar. Which is not exactly great, which could have negative implications for the trade deal that India is seeking with the US to avoid reciprocal tariffs. Commerce and Industry Minister Piyush Goyal recently visited Washington to advance trade talks, meeting with US Trade Representative Jamieson Greer and US Commerce Secretary Howard Lutnick. The discussions were described as positive and progressing well. However, there have been reports saying that India is seeking full exemption from the 26% additional tariffs imposed by the US, as well as the standard 10% baseline tariff in the ongoing negotiations for an interim trade agreement. Furthermore, India aims to protect its sensitive sectors such as agricultural and dairy farming by potentially setting quotas or minimum import prices for these particular goods. Will Apple's continued insistence on pivoting to India be a headwind to the progress that has been made so far? Could this derail trade talk entirely? These are questions that investors simply have to factor in, especially given how volatile the US president's decisions have been with respect to tariffs. In the long term, however, the Indian growth story, I've given you enough data points in the segment this week, remains firmly intact, as evidenced by pretty much every forecast being positive. As such, I am further affirming my bullish stance on India. But just because I'm excited to take a ride in a high-speed supercar, doesn't mean that I would forget to wear my seatbelt. On that note, set to the final segment, Dr. Dissects, where we're now switching from airlines to banks. The stock that is going under the microscope this week is none other than JPMorgan, ticker symbol JPM. Now, the bank reported its Q1 earnings last month, and JPM had a very strong start to the year with a beat on both the top and bottom line estimates. Q1 revenues came in at $45.3 billion, up 8% year over year, and beating analyst estimates by $1.2 billion. Diluted EPS came in about $5.07, up 14.2% year over year, comfortably beating analyst estimates by 43 cents. The bank's book value per share came in at $119.24, up 12% year over year, and tangible book value per share came in at $100.36, up 13% year over year. Net interest income, which has always been a key metric for the banks, came in at $22.6 billion. Provisions for credit losses rose slightly, coming in at $3.31 billion and missed analyst estimates by $2.7 billion. Return on equity for the first quarter came in at 18%, comfortably beating analyst estimates of 16.2%, and return on tangible equity came in at 21%, which is the same as the previous quarter. The company reaffirmed its 2025 guidance for net interest income, excluding markets, expected to be approximately $90 billion. The bank now expects overall net interest income to come in at approximately $94.5 billion, slight uptick from the previous guidance of $94 billion, which was also what the consensus estimate was. Those were the numbers, but we don't just speak about numbers in the segment. We also dissect the key takeaways and the developments happening with JP Morgan and so on. Now, I enjoy JP Morgan CEO Jamie Dimon's interviews and commentary. Really love the guy, especially given his penchant for colorful ways to describe the economy, policies, and regulation, amongst other things. During the first quarter earnings call, he described the trade war-induced panic that was seen in the treasury markets as a kerfuffle. Love the guy. Never sticks to boring phrases. It's always hurricanes and tornadoes, and now it's kerfuffle. There is, however, no evidence of any kerfuffle in JP Morgan itself, if Q1 results are to go by, despite the macro uncertainties becoming challenging with each passing day. Every single segment of the company performed remarkably well, despite the uncertainties that made JP Morgan CEO Mr. Dimon call the right now panic as a kerfuffle. What was striking to me was the growth seen in the consumer and community banking division. The year-over-year growth may have only been 3.7%, but it's a remarkable jump compared to previous quarters. For instance, the growth in the consumer and community banking (CCB) division stood at 1.5% in Q4 of FY24, minus 3.1% year in third quarter, and 2.7% in the second quarter, and now it is plus 3.7. So that's a remarkable jump. Given that the macro environment was even more challenging in the quarter gone by compared to the previous quarter, the fact that JP Morgan was able to achieve this particular growth, that too with a high base effect, demonstrates the bank's resilience and proves why investors should look at this name, especially during turbulent times like what we are facing now. The bank also announced the US consumer continued to be resilient despite falling sentiment, as reflected by a 7% year-over-year increase in debit and credit card sales volume. The growth was a lot higher than its consumer-focused peer, Bank of America, which saw credit and debit card spending rising 4% year-over-year. JP Morgan, however, did warn that the higher growth could be due to consumers front-loading their spending ahead of a potential increase in prices due to tariffs. Nonetheless, the CCB division's growth and performance is a testament to the bank's ability to weather a challenging macro environment, in my opinion. There was also continued strength seen in both the bank's corporate and investment banking division and its asset and wealth management divisions, both of which registered a second consecutive quarter of double-digit growth, although growth across both segments did show a decline. On a sequential basis, however, the CIB, the Corporate Investment Banking Division, registered a double-digit growth for the first time in 5 quarters. The bank also saw a 12% year-over-year jump in investment banking fees and maintained its number one ranking with a wallet share of 9%. The bank was also able to take full advantage of the increased volatility seen in equity markets ever since President Trump came into the White House, as demonstrated by a 48% year-over-year jump in equity trading volume. Overall, if there's one key takeaway from JP Morgan's first quarter, it is that the bank continues to be resilient to the challenging macro environment. Despite an elevated net charge-off rate, the bank was still able to demonstrate impressive growth in the CCB division, and both the investment banking and the asset wealth management divisions continued to be strong catalysts. What is even more impressive is that the bank has already made substantial provisions for credit losses as the threat of a recession continues to remain elevated, albeit lower than during the height of the tariff wars or the trade wars. This means that the bank, in my opinion, remains in a much better position should the so-called recession fears materialize. Furthermore, President Trump does seem to listen to Jamie Dimon, as evidenced by his recent admission of Mr. Dimon playing a major role in his decision to put a 90-day pause on his reciprocal tariff. Should this be the case for the future, then based on Mr. Dimon's commentary on the need for more deregulation, the odds of this happening have certainly increased, in my opinion. Should this materialize, should the deregulation materialize as planned, then it would be an additional tailwind to JP Morgan's growth. Today, in my opinion, investors need to be looking out for high-quality names to take cover as the macro environment becomes more and more uncertain. Based on its Q1 performance, based on its outlook, JP Morgan certainly fits the bill. Every time I talk about great things about the company, also got to look at the valuation. So let's talk about valuation now. According to LSEG data, formerly Refinitiv, the company currently trades at a forward price to book. Remember, banks we value on price to book ratio. Price to book ratio on of 2.08. So forward price to book ratio 2.08 for JP Morgan, making it the most expensive among its peers. And it's also expensive relative to its historical levels, with its historical forward price to book median multiple being 1.5. Last time I spoke to you guys about JP Morgan, I made my case on why JP Morgan deserves a re-rating of its multiple given the continued strength and resilience across all its segments. Despite tariff-related uncertainties, despite the bank's investment banking division expected to remain under pressure, at least until there is clarity on the current administration's tariff policies, the bank still reaffirmed its FY25 guidance. Furthermore, given that it is a more well-rounded bank compared to some of its peers, such as Goldman Sachs and Morgan Stanley, it deserves a multiple much higher than them. As such, I have assumed a forward multiple of 2.08. Forward price to book ratio of 2.08 for my calculations. It is slightly higher than my previous estimate of 2.03. Now, JP Morgan's book value of equity at the end of the first quarter stood at $351.42 billion. The company reaffirmed its net interest income guidance at $94 billion, which to me is a reasonable estimate even after accounting for tariff-related uncertainties. After accounting for a tax rate of 20.45%, the net interest income after taxes comes in at $74.78 billion. The company announced a 12% year-over-year increase in dividends for the first quarter, which is in line with the 10-year dividend growth rate of 11.42%. Assuming the company maintains a 12% year-over-year dividend growth and assuming the total number of shares outstanding is at 2.78 billion, the total dividends for FY25 are expected to come in at $14.32 billion. Based on the number of shares outstanding, the projected value per share for FY25 then becomes $148.15. So you have 351.42, which is your book value of equity, 74.78, which is the net interest income after taxes, and you subtract 14.32, which is the dividends. And then you divide it by 2.78 billion shares outstanding, and you get a book value of share of $148 of 115. So you have 351, which is the net interest income. 74.78 is basically your net interest income after taxes. This is the starting book value of equity, and this is the dividends basically after the dividend, assuming a 12% dividends, and this is the number of shares outstanding. You get a book value of share of 148.15. So this is book value per share, 148.15. Now, a forward book, a forward, a forward price to book of 2.08. Multiply that with 148.15, and you get a price target of $309, which suggests an upside of about 18.5% from current levels. So my price target is definitely higher than my previous one, which is 217, and that was calculated based on the track record of historical surprises rather than actual components. So this time I've actually computed it using the actual components, and then you get a more realistic price target of $309. So furthermore, despite the recent sell-off, JP Morgan continues to enjoy overall very strong momentum as reflected by the B plus grade on the Seeking Alpha's momentum scale. Even its short-term momentum stands at a respectable B minus. Given the considerable upside from current levels and given the strong momentum seen in the stock, I'm upgrading my rating on the stock from a hold to a buy. Price target of updated price target of 309. So updated price target of 309. It was a hold rating on the stock. I have now upgraded it to a buy. When it's a bull case, you've got to talk about the risk factors. And the main risk factor to my bull case on JP Morgan is that the recession does arrive a lot earlier than expected. And more importantly, it stays for longer. JP Morgan's own economists, after all, have raised the probability of a 2025 recession to 60%, although that's come down now. While there is ever since the the US-China trade war pause, while there is no doubt that JP Morgan's balance sheet remains strong, it still would take a hit given that it would have to substantially increase its provision for credit losses given the increasing delinquencies that would come with the recession. The credit card net charge-off rate has been steadily increasing in the last 3 quarters, albeit the growth has been marginal. In a recessionary environment, the growth rate would no longer be marginal, which would have a significant negative impact on the bank's bottom line. The second risk factor to my bull case is if the M&A environment remains subdued a lot longer than initially anticipated. There was a lot of anticipation that deal-making environment would get a boost under the new Trump administration, but so far, this is yet to materialize. The expectation now is that the deal activity picks up in the second half of FY25 once the environment becomes a lot more deregulatory in nature. Far from guaranteed, given that for now the FTC has announced that it would continue to maintain the Biden-era merger guidelines. JP Morgan's management during the earnings call also cited the need for uncertainty to be substantially reduced before deal activity can pick up. As such, if uncertainties do remain elevated, then the investment banking division of the bank would definitely be negatively affected. Bottom line, it was yet another strong quarterly performance by JP Morgan, with the banking giant comfortably beating both the top and bottom line estimates. Despite a challenging macro environment, the bank's CCB division demonstrated strong resilience. Furthermore, both the corporate and investment banking and the wealth management divisions registered yet another quarter of strong double-digit growth. Overall, it was an all-round, well-rounded performance from JP Morgan. The fact that the bank reaffirmed its guidance despite increasing its provision for loan losses shows that it has the capability to withstand the recessionary storm should we get one. Now, yet another diamond gold mine called it the recessionary storm or hurricane. From valuation perspective, the recent sell-off seen in the stock has made it attractive. Investors have started to get back in the name again, but yet there is considerable upside. And as such, I am upgrading my stock from a hold to a buy. New price target 309, previous price target 217, so significant increase. There might be hurricanes and kerfuffles occurring in the US now as the trade war continues. It continues to rage on. No matter how many pauses you get, it's still there on the table. But based on current evidence, JP Morgan remains immune to them. That's all the time I have for you this week. If you have a specific Indian or US stock suggestion for the doctor to diagnose or dissect, do tweet me at Uttam Vinay, UTHAMVINAY, or email me on thestockdoctorpodcast@gmail.com. Thank you once again for listening. I will see you next week. Until then, stay safe and make some money.